let's assume that we've got a claim for SR&ED. We've got a project, at least one project. We're confident we're going to write it up, and we've got the description done. Now the question is, how much money are we going to get back? What costs can we claim, and how do the credits work on that? So basically in Canada, the main expenditures, we'll talk about each one separately, are your wages, materials, payments to Canadian subcontractors, what they call taxable suppliers, and then allocations for overheads. Up until 2014, up until the end of 2013, you could buy capital equipment. We'll talk about that right now because there might be some guys who have shared use equipment or things that are still in, but that's being phased out in Canada, although in other countries it may be in. Okay? There's a concept of the tax credits, how much money do I get back, and there's another concept called the expenditure pool, which basically says if I have an R&D expense, let's say I'm in a loss position. I'm just spending money on R&D, but I don't really have enough revenues. I'm actually losing money each year. Typically, losses will start to expire anywhere from 7 to 20 years from when you incurred them. Now it's 20 years after, I guess, about 2010. So they don't expire right away, but they will eventually expire. One of the things of research expenditures is this idea called a pool, which says any of the expenditures that created my loss that are R&D related, I can choose, instead of creating a loss, to put this thing in an R&D pool, which is kind of like a loss, except it never expires. So if it takes me 50 years to get profitable, that's okay. In year 51, I can start using those expenses, which would have normally expired if they were a regular loss. Now they don't expire. Okay? So you can use that. Again, companies, if they have losses, when I'm looking at the loss carry forward, it's called Schedule 4, and in 2 or 3 years, there's losses from a long time ago. They're starting to creep up and risk expiring. This is where you want to start deferring as much of the pool to preserve those losses as long as possible. Okay? Oh, having said that, really, most people are focused on the credits. How much money is the government going to give me back as the main incentive here? So the basic federal credits are now 15% for pretty much any taxpayer. They could be a corporation, a general partner, an individual. So I could claim on my personal tax return if I want. Okay? And then there's enhanced tax credits for what they call qualified CCPCs, Canadian-controlled private corporations. So whether you're qualified means your income for the prior year has to be under a certain level, and your assets employed in Canada for the prior year have to be under a certain level. If so, the credits go up and they become refundable. Refundable means if I don't owe the government any tax, they give me all my credits as cash. Non-refundable, the top ones, basically means if I don't owe any tax, I get to carry those credits forward up to 20 years to the point I do become profitable. If I'm a big company, I got 100 million of losses, chances are I'm not even going to bother claiming credits because I don't need a non-refundable credit. Until I use up those losses, a non-refundable credit's not really worth anything to me. Now, basically there's a $3 million expenditure limit for qualified CCPCs that they earn these enhanced credits on. So that's the 35% federal credit instead of the 15%, and the full refundability. As their prior year's income for the associated group goes over $500,000 taxable income, they start to phase out that credit. As well, if their taxable capital, the assets that they employ in Canada on their balance sheet, go over 10 million, there's a phase out between 10 and 50 million. Okay? So basically, they're saying this qualified corporation definition is made for smaller companies with a certain lower level of profitability. Once your profitability goes over 500,000 or your assets go over 10 million, they stop considering you a qualified corporation, and now you're more of a medium-sized business. So there's a formula that goes in here. But basically the way it works is you've got a $3 million limit, and for every dollar of prior year income over $500,000, you use $10 off your limit. Okay? So very easily, now we're on the blue slide here. So if I had income of $500,000 or less, the first $3 million that I spend every year, I'm going to get my fully enhanced credits on it. If instead, let's say I had $1 million of income, now I would get no credits because I'm over the 800,000. Sorry, I would only get my 15% non-refundable credit. I wouldn't get my 35% refundable credit on anything. And in fact, I wouldn't get my Ontario credits because they follow the same kind of phase out. So what I would do as an accountant is I would often say to the client, hey, you made $1 million. Question one, how much money do you expect to spend on R&D next year? Do you expect to spend $3 million? If they say, well, no. We only expect to spend $500,000 a year is typically what we do. I'd say, well, okay, you have $1 million of income, and why don't we bonus out $250,000 to the owners? Okay, so they'll pay personal tax on that to bring you down to $750,000 here, which means the first $500,000 that you earn next year will get the enhanced credits, and anything over that limit will get the 15% non-refundable credit. Okay? So again, it's like a straight line phase out. And if you go over $500,000 taxable income, you want to start looking at bonusing down, depending on how much you want to spend next year. So that's one of the things that the accountant will help you plan at the end of the year. The other phase out, as we said, is on what they call taxable capital, or roughly the assets that you're using on your balance sheet. And of course, Ontario does a little different. Quebec has a little different definition, but basically we say as you go from 10 million to 50 million, there's again that straight line phase out of your limit. That used to be the way Quebec did it, and then when the feds in Ontario came up, Quebec said, oh, we got to be better than them, so they consider a smaller medium-sized business between 50 million and 75 million. So Quebec doesn't start to phase out its credits till you hit a $50 million taxable capital level. And again, each province can kind of do its own thing. As we mentioned at the start, Quebec has a very high incentive rate, much higher than pretty much any other province. Okay? So the way that the credits ultimately break down is there's provincial credits and federal credits. If we're a qualified Canadian-controlled private corporation, we'll have our provincial credits, some of which are refundable, some of which are non-refundable. Okay? So each province can decide if it's going to be refundable, and some make it refundable to qualified CCPCs and non-refundable to others. Again, each province does its own thing. We'll look at Ontario right here, because most of our claims are going to be based in here. Ontario actually has two credits. The Innovation Tax Credit, which is refundable, 10%, and then one called the ORDTC, Ontario Research and Development Tax Credit, which is non-refundable, 4.5%. Okay? So what can happen here, and this is a bit of a tax planning strategy, is with non-refundable credits, the client may choose to renounce them. Does anyone know why would I say no to a credit that the government wants to give me? Yeah, so the answer is it's because it's considered government assistance. So my question is, why would I want to do it? So this 4.5% is only usable against income taxes payable. If I'm in a loss position, what happens here is, we'll take this scenario, that I have a 35% federal credit, but you see I'm not getting 35% other than in places where there is no provincial. Okay? Because what happens is, I spend $100, but then Saskatchewan says, aha, you spent 100, but the province gave you 15, so you only really spent 85, right? And you get 35% of the net expenditure after government assistance. Okay? So the feds always take the provincial amounts off, and then they calculate on the rest. So my question would be, let's say we get this 10% credit. We'll compare it to Alberta, where we have a 10% credit. So on the federal side, if I spend $100 and I claim that Alberta credit, I would get $31.50 cash from the federal government. Whereas if I claimed here, I would only get $30 roughly. So I get an extra $1.50 by cash today by renouncing $4.50 of credits. So my question to the client is always, would you rather have $1 today or $3 in the future? And the question to the client usually, or the response to the client, will usually depend on how far in the future. If I got an order for $10 million right around, and I'm going to be profitable, no, I want the credit because I'm going to use it next year. Okay? If I'm like, wow, I've had 8 years of losses and it's going to be another 4 years to go, and I owe my employees some money, $1.50 today may be worth more than $4.50 5 years from now if I'm desperate for the money. So again, that's not a choice for me. I inform the client. I'm Monty Hall. Do you want door number 1 or I don't care. You pick. Do you want the cash now, today, or potentially more money in the future, but I don't know in the future. You tell me when you're going to be profitable. If it's 20 years in the future, you probably want the cash today. All right. So on the non-qualified CCPCs, there's only a 15% rate, and again, it's ground down depending if you claim these credits. Now, ironically, Ontario is one of these, as a provincial credit, will pay its provincial credit to public companies and foreign-based companies. That's 10%. But they do require you to meet the income and size test. So they got this kind of quasi-provision just to complicate things. All right? So when you claim the credit, you can basically carry it back for up to 3 years. If I have a non-refundable credit I can't use now, but I was profitable in the past, I can go back 3 years, or I can go forward 20. more details on it. Some of the major changes that came back in 2012 that are in place now is the federal ITC rate used to be 20%, it's now 15% for the large and public companies. That's why they tended, I found that the attack on the big companies was hit them with reduce their claim rate by 25% right there. And as we said, they're 2/3 of the claims anyway, so that really brought the budget for SR&E down significantly. They kept the ITC rate for qualified CCPCs up, but they're tending to deny the claims entirely. So I'd say that's even worse. Instead of losing 25%, they're losing 100% of the claim in certain industries. Okay? They reduced the qualified expenditures for contractors from 100% to 80%, saying the contractor has probably some non-qualified expenditures or whatever. They've ground that down. They've reduced the rate to calculate your overhead. So it's usually a percentage of your wages. It used to be 65, and now it's down to 55%. And there's other kind of tweaks that they do. And up until the end of 2013, you used to be able to claim capital equipment, and they've totally eliminated that. Okay? So some of the changes that you may have been tracking certain things, and now you no longer need to do that. All right. Now, I've focused more on Ontario because that's where the majority of our participants are, but one of the things I'd like to talk about is changes that came out in Quebec in 2014. And they're very significant, that they came out with an idea of one, standardizing their credit rates, which is fine. They reduced them a little bit, but more importantly, they introduced something called a minimum expenditure threshold, which says in Quebec, the first $50,000 that you spend each year doesn't count. Okay? So they had a lot of smaller claims that they were saying really took too much resources to go out and review for $15,000 or whatever, and they weren't strong, and they were taking too much audit resources, government resources. So they've put basically a benchmark saying if you're a small company under $50,000, forget about it. Don't even bother claiming for the Quebec side of the credits. I'm saying this is important because if the federal side takes something, then that'll affect small business significantly. Okay. Their rationale for it is that 40% of businesses had an expenditure of around $25,000 per business. So almost half their claims were relatively small claims that it wasn't really that significant, they felt, to the claimant, and that basically the administrative cost was overriding the benefits. Okay, so again, if we see similar things going, often what I find Quebec is the cutting edge of its rules. It comes out with stuff, and some of it works really good, and others don't work so well. Everything that seems to work well, the federal government after 3 to 5 years says, what a great idea. Let's talk about incorporating that. So again, when I see major changes like this, I'm watching for potential to be applied.